usually in Yes. Ms. Schattmeyer?
Here.
Ms. Forrester?
Here.
Ms. Cavanis?
Here.
Mr. Jurdy?
Here.
Ms. Smith?
Here.
Mr. Crummer?
Here.
Mr. Shoemaker? Ms. Harris is absent. And Mr. Anderson?
Here.
I did talk to Richard yesterday. He was out of the area and was having connectivity issues. He did not say he was going to be absent, so.
Okay, right. Well, thanks. I guess next we should have Pledge of Allegiance. Jim Anderson, would you like to lead us in pledge?
Sure. Ready? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Very nice, Judy.
Okay, thank you, Jim. Next on our agenda is public comments on items that are not on the agenda. Members of the public who wish to speak on items not on the agenda or the consent calendar, now is the time to do so. Do we have any members of the public wishing to speak on non-agenda items or the consent calendar?
I have no public comment at this time.
Okay. Okay, we have the consent calendar is minutes of the March 17th, 2021 board meeting and the March 2021 retirement report, along with the preliminary monthly financial report and the quarterly trustee education and training report. Are there any comments or questions on the consent calendar?
This is Sherry. I may need to abstain. I was not at last month's meeting, so I may need to abstain from the minutes.
Okay. Okay, thank you.
Just unfortunate.
Okay, hearing no other comments or concerns, the consent calendar will be approved by ratification on the board. Now we're on to item number 3, which is discussion of regarding the historical benefit review project status report. And looking to Doris or Jeff for that.
Thank you, Chair Jurdy. The report is included in your packet. I would like to apologize for the fact that the grand total line did not show up on the report that was provided in your packets. It fell outside the print range. That will be corrected by next meeting. With the current progress that's being made, I would estimate that it may take another 12 to 18 months for the project to complete because progress is much slower than staff originally anticipated.
Okay, any questions?
Doris, was that the total for the count of the type of correction that you're referring to?
Yes, there's a grand total line for the report that's missing all the way across, so you don't have grand totals on the dollar amounts or the counts by the error type.
Okay, thank you.
Yes, Ms. Smith.
I might comment that it's taking longer than expected. It seems to be much more complicated than originally expected. And I just appreciate, I mean, there's so much detail. I just appreciate all that you and the staff are doing. It just sounds like quite a lot of work.
Thank you. They certainly have their jobs, set out for them. It's a large project. It is significantly more complicated for certain types of corrections, and some of those will require essentially individualized, customized letters for the correction notice. So I do expect that it'll be harder to maintain a higher level of production when we move into some of those harder cases.
Mm-hmm. Right.
Any other questions or comments? Do we have any questions or comments from members of the public?
All right, no questions or comments from the public at this time.
Okay, thanks, Judy. All right. Well, that would then take us over to agenda item 4, which is the monthly investment report, along with the fixed income education and manager structure.
Morning, board. We've got Callan here today. They are going to dive into our fixed income manager structure just to continue the investment board work plan that we have got going on this year. And so I'll basically turn it right over to Greg. He can go over, portions of the investment report as well, highlights some of the big changes.
Okay, great. So it's good to see you all. I like the Zoom platform here. This should be great. Also want to make sure that I introduce Claire and Hannah as well. They're here joining me today, but I'll do most of the talking for the next little bit to talk about the fixed income portfolio. So to level set with everyone, we went through an asset allocation study, and we came up with targeted allocations to things like stocks and bonds, U.S., international, real estate, infrastructure. And then we've been going through making small changes within each asset class after the asset allocation study. And so today we're talking about the bond portfolio. And the punchline is that we're not going to recommend any changes to the bond portfolio. What we have, we think, is good. It's simple, it's efficient, and it's adding value relative to the index. So we like what we have. Now, I'm going to spend the next, 20, 30 minutes telling you why we like what you have. And at the end, actually not recommend any changes, but would certainly love to entertain any questions or hear how you might want to challenge us that what we have is good and that we shouldn't make any changes. And then at the end, maybe we'll spend a couple minutes talking about the flash report about performance, which has been quite solid. It's been a very good time to be an investor in the year-to-date time period. So with that, I'll share my screen, and we will start talking about the fixed income structure. Okay. Let me, I'm going to stop that because I brought it up on my wrong monitor and I'd be looking off to the side the whole time. Let me try this again. Okay. Can you see the presentation? Awesome. All right. So we're going to be talking about fixed income structure. And there's always a bit of a challenge when you're talking about bonds and bonds within a diversified portfolio, because there are conflicting objectives you often have with a fixed income portfolio. The number one objective we have is to find something that we expect to have return producing potential, but also diversify the rest of the portfolio. Now, the rest of the portfolio, your stock portfolio, your real estate, your infrastructure portfolio, they all have a higher returning potential than bonds. They all have more gas in the tank. But what we want to do also with the bond portfolio is to make sure that it diversifies those other assets, which means that when they're down, the bond market is up, and it lowers the overall volatility of the plan. One thing we've been working on with the investment portfolio for a long time is bringing in diversification and lowering overall volatility. A couple things we've done is introducing or increasing real estate and infrastructure. But what we've also been doing is keeping the fixed income portfolio relatively conservative, not juicing it up with a bunch of other equity surrogate instruments. We've been keeping it pretty simple. And we think that's good because you only have about 21% of the fund allocated to bonds. So it's not a lot. And so what we want it to do is act like bonds when we really need bonds. Okay. Overall, we want the fixed income structure to stay neutral to the broad market. And that's generally considered an index called the Bloomberg Barclays Aggregate Bond Index. That's essentially the S&P 500 of the bond world. So we structure our portfolio around that index. And we want to, again, make sure that it remains of high quality in flight to quality environments. So I'll show you a few charts that kind of illustrate that. So desiring fixed income to be that diversifier, sometimes people use the term, it's the anchor to windward for you sailors out there. It means that in choppy waters, it is the thing that stabilizes you, right? The anchor. So let's demonstrate that here a little bit. What this chart looks at are the time periods where the equity market is down. And those are that's the blue bars here. So in all of these charts, what we're showing are equity market drawdowns. And you see the equity market drawdowns can be pretty meaningful, down 3 to 5%, but it also can be down 46%. And that was in the global financial crisis. Okay, so the blue bars are equity market drawdowns. What the green is showing is what did the bond market do in those time periods? Well, the bond market was up in all those time periods. So the purpose of bonds here is to provide that cushion, a little bit of positive return when the stock market is down. Now you'll note in 1994, one thing happened there that the bond market and the stock market were both down at the same time. And in 1994, there was a surprise increase in interest rates by the Federal Reserve. And that increase in interest rates led to losses in both the bond market and the stock market. So that's what caused both of the markets being down in 1994. I bring that up, and it's something I've been bringing up for about 10 years now, because there are certain scenarios where if interest rates go up, both the bond market and the stock market can go down in value. And in fact, we saw that in fourth quarter 2018 recently when interest rates went up and the stock market went down for that reason. Okay, but absent that one narrow scenario, you look at all of these other time periods, the bond market is generally up when the stock market is down. When we build a bond portfolio benchmarked to the Barclays Aggregate, there are generally 3 different strategies, manager strategies one can consider. Okay, the first is passive, so buying an index fund. Now, index funds are great in that they're low cost and you know what you're going to get. But the problem with them is that you lack the ability to add value in less efficient markets. In general, bond managers have demonstrated an ability to add value net of fees if you give them certain latitudes within their portfolio. So the con of passive here is that you're giving up a little bit, that certainty, you're giving up a little bit of potential value add. The next major flavor of bond investing relative to the aggregate is something called core fixed income. So that's where you give the manager a little bit of latitude to add value, but they primarily stay within the sectors represented by the Barclays aggregate. So those sectors are treasuries, governments, government bonds, U.S. treasuries, agency bonds, mortgages, corporate bonds, asset-backed securities, commercial mortgage-backed securities. All investment grade is in the index, okay? So some of these core managers, you might give them a little bit of latitude to buy a little bit of below investment grade, but they generally stay pretty close to the index. So they're active managed, but they have some guardrails around them. So that's core fixed income. Now you have a manager that we're categorizing as core fixed income, Dodge and Cox, but they do have about 9 or 10% in below investment grade, but it's the very first rung of below investment grade, BB rated corporate bonds. The third major flavor is Core Plus. And that's where you give the manager latitude to invest more meaningfully outside of the index. They might buy emerging market debt, more high yield, international bonds, currency, that sort of thing. So you're giving them a lot of latitude to add value relative to the index. And we have a manager there as well, Pimco. The Pimco Total Return Fund falls into this Core Plus camp. Okay. So these are the three major building blocks. We've decided to not have any passive, and then we have some in what we call core, and then some in Core Plus. I'll show a little more detail on that in a little bit. So the next few charts, we're going to look at the return expectation, the standard deviation expectation, and the correlation of bonds. So those are kind of the three main things, return-based characteristics you look at any asset class: return, risk, correlation. Okay, so what's our return expectation for fixed income going forward? And I think Jay spent some time talking about this when we did our capital market review. What we're looking at here is the yield on the aggregate index, the broad market index. That's the dark blue. And then the kind of the teal color is what was the return earned by that, by the bond market 10 years forward. So you'll see, you know, it's what year is it now? 2021? It's hard to keep that straight. But the return for the green line, 10 years ended today, is very similar to what the yield was for the index 10 years ago, the blue line. And you'll see this relationship is very tight over time. There are small deviations, but the relationship is very tight. So your beginning yield is very indicative of how much money you can make in the bond market. So right now, the blue line, where we're at today, is pretty darn low. We expect bonds to earn 1.5% to 2% on average for the next several years. So our earning power is much lower today than it was in the past. It's part of the reason why we only have 20%, 21% of the portfolio in bonds. So return expectations going forward, lower than they were historically. So let's now look at volatility. So we looked at return, we're going to look at volatility, then correlation. Okay, so now let's look at volatility. What the green line here is showing is this bond index looking at their rolling 3-year returns. So if you held it for 3 years, what sort of return would you get? That's the green line. The reddish line is the stock market, the rolling 3-year returns. You know, a couple big takeaways from this is, boy, that red line generally above the green line. Yeah, stocks return more than bonds. But the red line is also up and down quite a bit, right? It's up and down quite a bit. The green line has always been positive in the past. You know, we'll see what happens going forward. But it's also in a much tighter range. the predictability of bonds returns is much tighter than stock market returns, right? So lower risk, that's the big takeaway here. Much lower risk, much more predictable pattern than the stock market. And then correlation here. Let's look at correlation. So this is correlation relative to the US stock market, the S&P 500. So when the number is high, it means you're highly correlated. When it's negative, it means you're negatively correlated. When one is up, the other tends to be down. And this is looking at different components within the bond market. The light green color is this index we've been talking about, the aggregate index. It tends to have zero or negative correlation to the stock market. It means it's a good diversifier. Treasuries and long treasuries in particular also tend to have negative and or close to zero correlation to the stock market. Okay, but let's look at these other things that you could consider putting into the portfolio. Risk-seeking bonds. So we're looking at high yield, below investment grade. We're looking at bank loans, which are also below investment grade, and emerging market debt. And you see the correlations are not always stable, yet they tend to be very highly correlated to the stock market. And for that reason, and when you only have 20%, 21% in bonds, that's why we don't think we should be going out and putting even more bank loans, even more high yield, even more emerging market debt into the bond portfolio, because what you're really doing is just increasing your exposure to the stock market indirectly, or risk assets in general. Okay. So the next two charts here, changing gears just a little bit, the next two charts here show what the our existing fixed income portfolio and different indices, how they act in rising interest rate environments and then spread widening environments. Okay. So here on page 9, we're looking at environments where interest rates increase meaningfully by about 1% or so. And so we highlighted those time periods when it's early 2010, 13, 16, 18, et cetera. And then today. As a quick segue, during the most recent COVID crisis, 10-year treasuries got as low as about 0.5%. Earlier this year, the 10-year treasury went up to 1.7%. It's now back down to 1.5%. So we are a full percentage point off of our low in terms of 10-year treasury yields. So we've had already a pretty meaningful backup in yields. Okay, so a couple of the takeaways here is that the blue bars here are the Mendocino Portfolio. And how do they perform in rising interest rate environments? In general, the combination of our managers, Dodge & Cox and Pimco, tends to outperform the broad market in a rising interest rate environment. That means the fixed income managers tend to be a little short in duration, Dodge & Cox in particular, or tend to manage that well when that happens. Part of it could be their overweight to credit, which tends to be correlated with a sell-off in the bond market. So this is an interesting characteristic of the bond portfolio, how we have it structured. Now, you might ask the question, well, what happens when spreads widen? And we're showing that. And not surprisingly, the portfolio tends to underperform the index when spreads widen. So the active managers we have, Pimco and Dodge & Cox, tend to overweight credit or mortgages or something a little bit. And for that reason, they tend to underperform when the spread when spreads widen. And it's pretty common characteristic of active fixed income managers. So I mentioned earlier that in general, fixed income managers have demonstrated an ability to add value relative to the index. And you might reasonably ask, well, Greg, what's the proof of that? So we have a couple of charts here to demonstrate that. And what we look at is peer groups. So Callan, we've got a database going back 40 some years, and we look at the performance of active managers over that, multiple decades. And we ask the question, over a 3-year time period on average, how much does the average fixed income manager outperform or underperform? And we also ask the question, well, how much do they outperform or underperform relative to their fees? For core bond managers, they tend to outperform by about 36 basis points. Okay. And if they pay a fee of, let's say, 40 basis points, the 40th percentile manager outperforms 60% of the time. So it's not a layup for core bond managers, but they do have some demonstrated ability to add value. Now, what is a little more compelling is core plus managers. So if you give them a little more latitude to invest outside of the index in a risk-controlled manner, you see the average outperformance over this time period is 75 basis points. And the average manager beats the index by 40 basis points at least 70% of the time. So in investing, we're never going to get everything right all the time. You make several decisions, and you hope that 2/3 of them work out. If you win 60 to 70% of the time, 2/3 of the time, your investment strategy is a success. You cannot expect to win 100% of the time. But if you know, okay, I'm just trying to win 60, 70% of the time, and that's going to win over the long run, that's a really good strategy for an investor. And here you'll see that that's the way the bond market has the active managers in fixed income have added value over time. And this last chart here, this is more of kind of a thought piece. And we borrowed this from a bond manager called Western Asset Management. And we've talked about the fixed income market with this group over the years and about how US yields are so low and they're bound to increase because they're so low, and you can't make a lot of money because they're so low. But we also asked the question, well, what if you were overseas and what's going on with international markets? So what this chart shows are the government yields offered by other countries. And this was at the end of the year, so it's a little bit dated for the US. Well, you see in the United States, here are the yields you could have earned across different maturity spectrums. So the 10-year Treasury for the United States at the end of the year was yielding about 90 basis points, so 1% a year. And the 30-year Treasury was yielding about 1.65%. And you see it's color-coded slightly green. What countries are yielding more than the United States and therefore, might have a little more earning power? They're the ones below it here. So South Africa, Brazil, Indonesia, Mexico, China, Malaysia, South Korea, Poland. Emerging market countries. Now, they're yielding more, but you also very well may be taking on currency risk, whether or not the bond is hedged. And then also, if you look at the credit quality rating, your belief that you will be paid back when you want to be paid back, it's lower in these countries as well. And we also saw earlier the higher correlation of emerging market debt to the US stock market. So that part's interesting, who yields more than the United States. The other part that's interesting is who yields less. And there are a whole lot of big economies out there that are yielding less than the United States. Switzerland, Germany, Netherlands, Denmark. So the Euro bloc, all negative yields in the 10-year out, really almost to the 30-year part, and in part of it including the 30-year part. So negative yields, and that's kind of a hard concept to wrap your head around. What that means is you lend someone $101 and they give you back $100. That's what a negative yield is. It's hard to think about, right? Because it breaks so much of our concepts of the time value of money. So that's what's going on in Europe. You'll see Japan is essentially zero or negative across the board, and then the UK is negative on the short end and then slightly positive on the long end. So what that means is that the United States, yes, we have low yields, but we're higher than overseas. And for that reason, non-US investors very well can continue to demand US bonds because we're better than them. Is kind of the thought process there in terms of yield, where, you know, if you're a German investor and you've got a negative yield, you might just very well like that 1% yield offered in the United States. So now we're going to talk a little bit more specifically about the Mendocino portfolio. And here we're showing how it's currently allocated. So we've got about $120 million in bonds, representing, we're a little below target as of this measurement date. This is as of the end of the year, about 19% of the portfolio at that time. And we're equally split between two managers, Dodge & Cox and Pimco. And we've had Dodge & Cox and Pimco in the lineup for quite a while. The last change we made is when we swapped out a firm called Bradford and Marzak. Jim Anderson might remember them from several 7 to 10 years ago. But we've had the Dodge & Cox and Pimco combination for quite a while. And it's they work really well together, because they do things different from one another, and cumulative returns are both additive. So they not only diversify the equity portfolio, but they also diversify each other within the fixed income structure a little bit. So here's the performance for the fixed income portfolio within the total plan. It's the blue dot. And you'll see the blue dot is above the green triangle. These are net of fee returns, by the way, which is the index. So the blue dot's looking pretty good relative to the triangle. So we've been outperforming across all of these cumulative time periods. In addition to that, it's ranking pretty well relative to other public funds. Well, what we're looking at here are other public funds. The peer group is other public funds fixed income portfolios. So this fixed income portfolio has been doing better than other public fund fixed income portfolios. And I could speculate a little bit. I think one reason we're doing a little bit better is the managers we have are doing well. The other thing is that some other public funds tried to add a little bit of more risk to their portfolio, or they were convinced interest rates were going to go up 10 years ago. And they shortened their duration or did something in response to it, added global bonds. That was a big fad 10 years ago. And we kind of stuck to this simpler, more transparent strategy. And it's worked out over time, where some of those other strategies have disappointed. So here we take a different look at the aggregate fixed income portfolio. And I think they're just, we have calendar year returns up top, risk and return down here on the right. We tend to have slight, slightly less standard deviation, higher returns on that chart. But I find this chart on the bottom left to be interesting, where we're seeing what quarterly time periods does our fixed income portfolio outperform or underperform the index. So you'll see that there are a lot of so if the bar is above the line, it means the fixed income portfolio outperformed the index net of fees. If it's below, it's underperformed the index net of fees. So we have a lot of bars above the line, kind of eking out little singles and doubles. And then you have a couple drawdowns here. One is in the fourth quarter of 2018. That's that rising interest rate time period where people thought interest rates were going to go up, and then this risk assets sold off. The fund underperformed, 60, 70 basis points that quarter. And then here's the more meaningful one, and this is the first quarter of COVID, first quarter of last year, where we had a meaningful sell-off, and that's when the stock market was down 30%. Our bond managers underperformed the index a little bit, nevertheless produced a positive return because they still act more like the index. And but we stayed patient, and then the managers came roaring back once the liquidity issue cleared up in the market. And you'll see that for 3 consecutive quarters. After that, they outperformed, and by a meaningful amount in those time periods. Here's some aggregate characteristics of the fixed income portfolio. The total portfolio has a duration of 5. And duration is the measure of interest rate sensitivity. So if interest rates go up 1%, all else equal, your portfolio goes down 5%. And then vice versa, if rates go down 5%, the bond portfolio goes up 5%. That's what duration means. It's the change in price driven by the change in interest rates. So we have a duration of 5, and it's below the index duration of 6. And that's largely because of the Dodge and Cox shorter duration position. The yield in the portfolio at the end of the year was a little under 2%. So not heady returns, not heady yields, but a positive yield. And then over on the far right, we could see what sort of sectors we have exposure to. So these are a little hard to read, but it's corporate bonds, mortgages. So you and I have a mortgage from a bank. That bank takes that mortgage, packages it, sells it to investors like Dodge and Cox and Pimco. That's the mortgage component. U.S. Treasuries, the United States government, government related. So this would be GSEs or Mexico. Non-agency mortgage, asset backs, and then we get to some smaller sectors. Be glad to talk to you about them if there's interest. But the major food groups here are corporate bonds, mortgages, treasuries, securities. Those are the major food groups there. So now we'll take a quick look at the 2 managers who make up the structure. The first is Dodge and Cox. So we're calling them core bond, but as I mentioned, they do have about 9% in below investment grade corporate debt, almost all BB rated, which is the highest quality within below investment grade, if that makes sense. That's why they're kind of a tweener, whether they're core or core plus. So we're just calling them core here to put them in a bucket. Performance, you'll see here, is very good across the board relative to the index and the peer group. They are a bottom-up manager, happen to be headquartered here in San Francisco. A bottom-up manager, emphasize corporate bonds. if you look at their portfolio and you look at the top 10 holdings, there'll be names you recognize: JP Morgan, corporate bond, you know, IBM corporate bond, just a big corporation that you would probably recognize. That would be their largest holdings. Bond portfolios are complicated by their nature, but if you look at this portfolio, it's one of the more easily understandable ones out there. They tend to be a little shorter duration than the index over time. And that's demonstrated on the bottom left-hand chart and with their duration up here. The other manager is Pimco. So Pimco manages the portfolio differently, and frankly, it's more complicated. It's a core plus manager, and they have latitude to invest in things like high yield, emerging market debt, bank loans, but that tends to be less, you know, the maximum of only 25–30% of the bond portfolio. The majority of it remains US dollar denominated investment grade debt. They're a top-down manager, which means they just think differently from Dodge & Cox, which looks at a company first. They look at the economy first and decide, do I want to be overweight or underweight something? What do I think of the United Kingdom yield curve? So recently they were short United Kingdom yield curve, right? So it's just a very different way to think. They tend to have, within the mutual fund in which we invest, they tend to have derivatives, and they are very active in managing things like duration and yield curve. So a little more complicated. And you'll see performance in the blue dot. You know, it's better than the index. And these are net of fees. So they've done better than the index fund, and they've been kind of average-ish relative to the peer group. In part because 2019 was kind of a tougher time period for them. But overall, they've done what we've hired them to do: go out and beat that index and bring a little more diversification to the fixed income structure. Okay, the last item on this that I'll focus on is a quick update on the way the portfolio performed in March. So I mentioned that interest rates went up from our low of 50 basis points to as high as 1.7 and change in the 10-year Treasury during first quarter. I'm sorry. So we hit that 1.7 and change during the first quarter. The low was about a year ago. So let me clarify that. But during the first quarter, that index that I've been talking about, the Bloomberg Barclays Aggregate Index, was down 3.37%. That is the worst bond return in 40 years for a quarter. So there are a couple things going on there. One, interest rates went up, but two, the starting yield is lower than it's been in the past, so there's a little less cushion to absorb a sell-off in the bond market. So for the quarter, bonds had a negative return, negative 3.37, and the worst in 40 years. You look at the stock market. I mean, this is like 3 days of down market in the stock market, right? Volatility-wise. But one thing to note is the managers both outperformed, and collectively the portfolio outperformed the index in this down market, which is a good thing. So the portfolio was down 2.8%, index down 3.37. It's a loss, but I still think there's a victory in there in that we still outperform the benchmark. If you look out over longer time periods, we're looking at that 4 to 5% return amount, and that's about what we expected bonds to do, 7-8 years ago. That was our starting return expectations, and we've outperformed the benchmark over the longer time period. So that's kind of a summary of the way the fixed income portfolio is structured. and we're not recommending any changes. And sometimes when you sit down, you think hard, you look at something, and you decide to do nothing, that is a decision in itself, right? That, you know, we've looked at this in the past, we think it's good, and we think it still works. And we did the analysis, and our decision is to continue to do what we're doing because we think it's working pretty well. Okay, and so that's our formal presentation on the fixed income. I'd be delighted to answer any questions you might have.
Quincy?
Yeah, Greg, I think you made a mention earlier about our target allocation mark for this type of investment. I think you said 20 or 21. Is that something, it might be more targeted for Robert, that we're continuing to adjust to get closer to that mark, even though we are potentially keeping with the same investment strategy?
Yeah, and in fact, there was a whole bunch of rebalancing that went on in first quarter. So in the next, when we talk about the monthly return, you'll see how Robert actually went through, and he did a lot of rebalancing work in the first quarter to bring us back to target. And
I've seen that on all of our reports, yeah.
And one thing I want to also make sure is clear for everyone is that the portfolio at that point was a little underweight bonds, and it's not a conscious decision by us or anyone to, hey, I want to be short the bond market. Instead, it's just the stock market ran up so much, and now you've got $640 million, where not long ago you were at $500 million, that everything else appreciated, the bond market didn't appreciate as much, so now you just need to rebalance back in to the fixed income market. So it's not a tactical thing in any part, it's just everything else appreciated so much.
Okay, Jim?
Yes, thank you. Greg, I know, again, been a long time ago, but with the, when Pimco lost Bill Gross and they had all of the changes and they lost a lot of assets under management, and sitting here looking at them so close to the index, I'm just wondering, as an investor, have they ever recovered their assets under management, and kind of what is their standing in the bond investment kind of environment?
They are still a behemoth, still a mighty behemoth in the bond market. I don't know how many trillions of dollars they have under management. And Hannah, I don't know if you can pull that up, what Pimco's AUM is now, but they are behemoth. Bill Gross did leave several years ago now. And a guy named Scott Mather is the head of this product and co-CIO over there now. Scott Kiesel is the co-PM. Mohit Mittal is the other co-PM on the Total Return Fund. They're all longstanding Pimco employees. You know, after Bill Gross left, they actually bounced back a little bit. They did pretty well. I think the last couple years has been a little bit more challenging for them. I think Pimco is not immune to criticism for their performance, and they also have some other things going on within their organization right now that we're kind of keeping a close eye on to see what are the implications of some of the things you read about in the press about corporate culture. I think that's something we should also, make sure we know what's going on there. Hannah, how much does Pimco have?
It's 2.2 trillion, looks like.
I think you're on mute, Hannah. You might be double muted.
Can you hear me now?
Yes.
As of year end, it's 2.2. They don't have an updated figure for Q1.
Thanks, Hannah. Thanks, Robert.
Thank you both. All.
In 2016, they had 1.5 trillion. So.
Yeah, and I think BlackRock, it's amazing when you look at these asset management organizations. I remember when Pimco breached $1 trillion, and everyone thought, wow, that's a lot of money for one organization to be managing. But BlackRock might be 7 trillion now. I mean, the numbers are astounding. And it's a really interesting thing going on with our industry where there's so much consolidation. And passive is a big motivator of that, but also cost structure is driving a lot of firms to combine, and then the big are getting really, really quite large.
Okay, all right. Well, I'm not seeing more questions at this point. Do we have any members of the public who have questions? Richard, see you're on the call. Do you have any questions? Okay, all right. Well,
Not seeing no hands raised, no questions at this time.
Okay. Is there more from your firm, Greg?
Yeah, you know, maybe I'll just walk us through do you want to take a look at the month of March flash report?
Sure.
I mean, it should make us feel generally good. Did that work? Am I sharing my screen again? Yeah, okay. So assets at the end of March hit 664 million. Investment gain in aggregate was about 12 million. This is the month of March. And then here is what we call net new investments. So that's total money coming in or total money coming out of the plan. So about $1.2 million left the plan for benefit payments. And I mentioned that we've been doing, or Robert has been doing, a lot of rebalancing work. And you'll see that we took down domestic equities by about $11 million, international equity by 26 million, added 19 million into fixed income. That got us back to 22% fixed income. And then we have real estate here at 9.5. Now you'll see down here, and Robert's been doing a lot of work on this. This is the cash position at the end of March is $17 million. That sat there for, kind of a matter of days. It's actually funding the JP Morgan Infrastructure Fund. About $16.7 million will be invested in that fund, or already has been. It's April 1st. So this is kind of like a snapshot in time, snap a picture of money moving out of one asset class into another. And so the next report you look at here, you'll see about $16.5, $17 million in the new infrastructure fund that we identified through the asset allocation and manager search several quarters ago. And it's taken a while for them to call the capital, and they finally called all of the capital in March. So that's the rebalancing work, and then where cash is sitting. And then return-wise, domestic equities are up for the month, about 4% of March. End of March, we were hitting all-time highs in the stock markets. And then we have fiscal year to date. So this is a 9-month time period here. Fiscal year end is June 30. So this is a 9-month time period, and then longer time periods. So stock market up about 4%. One thing, and we'll spend more time talking about this at the next quarterly meeting. huge rotation out of growth stocks to value stocks, stay-at-home stocks to we're going back to work stocks. So you'll see that kind of the managers that were doing so well, strategies doing so well during the pandemic, are losing ground now. So you see that the mid cap growth, small cap growth, negative for the month, and then you'll see Prudential up 8%, small cap value up 8%, and mid cap value up 7%. So a real big shift is going on. A lot of it having to do with when do we go back to work. You may have seen in the news today, Netflix. I think at one point today, Netflix was down 7% or something. So again, going to that pandemic to exit sort of mentality. International markets were up for the month, about 1%, underperformed a little bit. Dragger was the Euro-Pacific Growth Fund. This fund has been our strongest performer over the long run, but has a growth bias, and so that for the month there was a headwind there. Emerging markets also underperformed a little bit. The bond portfolio for the month was down about 1%. And then real estate here, we have up about 1.7% for the month. All in, total fund up about 1.8% for the month, outperforming the target. We don't have the year-to-date number here. We'll share that with you at the May meeting. But for the fiscal year-to-date, returns look very strong right now, up 25% relative to about 20% for the index. So glad to answer any questions you might have about the flash report.
Let's see. Okay. All right, I guess we're getting ready to hear from the actuaries.
Thank you, Chair Jurdy. So we're going to move on to item 5, which was the Siegel study regarding the board's questions about modification of the amortization of the restart layer. Our actuaries are available on the line. The report fleshed out 3 different scenarios, and I think I'll just turn it over to the actuaries for a brief overview, and then they can answer questions that you may have regarding the report. Dirk or Andy, would you be happy to speak on this?
Yeah, good morning, Doris. Good morning, Mr. Chairman Jurdy and other members of the board. I'm Andy Young, joined by my partner, Dirk Adamson. I can put the report on the screen if it is helpful as I go through some of the highlights of the results. So is that a good idea if I try to do that?
Yeah, thank you.
Okay, I'll do that. Thank you. Give me a minute.
Well, thank you, Greg and Claire.
So everybody can see my screen with the copy of the report that Dirk and I prepared for Doris.
Yes,
okay.
We can see it.
Yeah, thank you. Yeah, so by way of background, you may remember when Dirk and I present the June 30, 2020 evaluation report at the November meeting. So some members of the board have expressed interest in trying to find out how what would be the best way to buy down some of the unfunded actuarial, the accrued liability of the plan sooner rather than later. So we, when we talk about the progression or the change in the UAL, the one thing that we identified, the board very quickly pick up on, is the fact that in the 2012 valuation, and actually before that, there was a motion made by the board to restart the amortization period. So when we look at the amount of that UAL layer carry over now from the 2012 valuation, the observation was made that whereas we start that layer at about 126 million, but when you look at the balance in that layer in the 2020 valuation, not only has it not gone down, but actually it has gone up. So the amount has gone from $126 million to the $134 million it is today. And so the board may remember we said that it's all due to the fact that there is negative amortization going on. I have to put the word net amortization in air quotes. So this happened as a result of us building the contribution rate to the employer as a level percentage of payroll and using the assumption that we have today, assuming payroll will grow at the assumed rate of 3.25%. So the board says, okay, well, what can be done in order to pay off this unfunded liability sooner rather than later? Because after all, as we have indicated in our letter report to Doris, that is by far the longest layer that we have in the amortization period, because right now, everything else is shorter than 18 years, but that layer was 19 years. So Doris and the board put together some assumptions or some scenarios that you would like us to take a look at, and we have included 3 in this report. The first scenario is to basically take down the 19 years and reduce that by 1 year to have 18 years be used to amortize that UAL. Now, I would have to point out, and we did so in the report, that everything that we have done in this report make the assumption that we would go back and redo the 2020 valuation as if we were changing the amortization period for that valuation by 1 year to 18 years. Now, of course, that's not going to happen, because the soonest, if the board were to decide to take any action, would not be until the 2021 valuation. But we think that it will still give you the results in this report, will give the board some indication as a direction of how the contribution rate is going to go in the future valuation, if you decide to take some actions to either increase the contribution or to reduce the amortization period. So with that, I'll go through maybe the first scenario. So under the first scenario, we have 3, like I said. Under the first scenario, the amortization period would be reduced from the current 19 year to 18 years, and all hypothetically as part of the 2020 valuation. Now, under this scenario, the contribution rate that we would have calculated in our 2020 valuation report for all the employers, and of course the county is by far the biggest employer with 95% of the payroll and close to 95% of the total contribution, is 37.65% of payroll. So this is the baseline with a contribution of about $28.4 million in that valuation. So now if we go in and reduce that amortization period from 19 years to 18 years, and assuming that the county and the other 2 special district employers, the cemetery district and the court, were to be amortized over the 18-year period, the amount of the contribution, whereas calculated in the 2020 valuation was 37.65% of payroll, will now go up to about 38.19% of payroll. So the change in the contribution rate, or the increase in the contribution rate, is a little bit over 0.5% of payroll, 0.54% of payroll. In dollar terms, it's about $400,000 per year. So in this case, there's an increase in the contribution rate requirement by about 0.5% of payroll for about $400,000 a year. So definitely in the short term, there would be an increase in the contribution rate requirement for all the employers, and in which case the county will be paying almost 95% of this amount. So then if you were to ask Fiscal, so what's the trade-off? What's the benefit of passing on a higher contribution rate increase for the employers, right? So if we were to ask the employer to make an additional contribution starting in the 2020 valuation of about 0.5% of payroll, so what would be the trade-off? Now, we do have an amortization schedule that I'm going to show you now to show you how it will actually result in long-term savings for the employers, and in particular the county. Because remember I said for that layer, right now, the UAL is being paid off over a period of 19 years. If we look at the so-called amortization schedule, it is almost like we go to the bank and ask the banker to show us how much contributions we have to make in order to finance the house that we're trying to buy. And if the original payment period was 19 years, the first annual payment would have been about $9 million, $9.7 million. And remember I said early on that the payments are scheduled to increase at the assumed rate of payroll growth at 3.25%. So next year's payment is going to be slightly higher, and it's now going to come in at $10 million. But if we look at all the payments total, we would be asking the employer to pay not the original $134 million in UAL that we have, but the actual payments that we'll be collecting would be about $249 million. So for sure that after 19 years, the original UAL would be paid off because that's the principal that the employer will pay. But if you focus your attention on just the interest we'll be charging the employer is $115 million. So it's not as big as the principal that we are asking the employer to pay, but it's coming in at 80–90% of their principal amount. So if you remember or write down the $115 million, so this is under the 19-year amortization period. But if I now skip over to the 18-year payment schedule that we have included under scenario number 1, the contributions is now bigger by about that $500,000 that we were talking about. The total that we'll be asking the employer to pay over 18 years will still pay off the debt of the $134 million. But instead of charging the employer, the county, interest over the next 19 years of $115 million in the first scenario, now the amount of interest that we are asking the employer has been reduced to $107 million. So the reduction in the interest in this case is about $8 million. So to summarize at least the first scenario, the contributions will have to go up by about $500,000, about 0.5% of payroll during the first year, so $400,000 I should have said. But over the course of the loan, 18-year loan, the amount of interest charged would be reduced by almost $8 million. So the county is still going to pay off the principal, but the interest that we would charge them would be less by almost $8 million. So that's the first scenario, just changing the amortization period by 1 year, increase the contribution by about 0.5% of payroll, $400,000 in the first year, but we would be able to save the county and the other employers combined together interest of almost $8 million. So that's the first scenario, just for a 1 year reduction in the payment schedule. Okay, so now I'm going to go back to the body of the letter, because in the second scenario, instead of reducing the payment amortization by just 1 year to 18, so now we have been asked to take a look at what happened if the payment period is reduced by 4 years, from 19 under the baseline to the 15. Now, in this case, the contribution rate requirement is going to go up by about 2.6%. So it's really not 4 times as much as the 0.54. It's actually almost 5 times. So because these things are not linear. So that's why you want Fiscal to take a look at a couple of scenarios for you. But along those lines, even though the contribution is going to go up in this particular case by 5-fold to 2.66% of payroll in dollar terms, about $2 million. But in this case, if I go to the amortization schedule, so while I'm going to the first schedule, still revisiting the $115 million in interest that we have under the baseline. Now, instead of $115 million in interest, in this case, the interest charge is actually reduced to $85 million. So $2 million in additional payments in the first year, about $2 million in the first year, but the interest charge is reduced quite dramatically from about 115 to 85 million. So almost like a $30 million reduction in the interest charge if the amortization period were to be reduced from all the way from the 19 down by 4 years to 15 years. Okay, so that's the second scenario. Now, of course, I want to point out again that in order to save the interest of $115 million, we would be asking the employer to make additional contributions. And in the first year alone, it would be $2 million. Now, I know that that's going to be could be burdensome for the employer. So that's why I think the board come up with a third possibility. Now I'm going to go back to the body of the letter and revisit for you, refresh your memory as to what the first scenario is all about. I think when we were looking at the amortization schedule, some members of the board pointed out to Fiscal that Right now, when we provide the contribution rate requirement, that 30+% of payroll contribution rate requirement for the county and the other employers, actually the employer is not only making a contribution of close to 37, 38% of payroll. And the reason why that is the case is many years ago, actually the county has issued pension obligation bonds in order to buy down the UAAL at the time when those bonds were issued. So well, maybe the good news is, while the county has continued to service those bonds, those contributions of the bond payments would be fully amortized, would be fully paid off in about year 2026-27. So as a matter of fact, those payments are expected to, the county's obligations are expected to drop by about $4 million. And in year 2027-28, they will no longer be required to make any of those contributions. So some members of the board said, well, what if we were to take hypothetically, take that $4 million that the county would have otherwise budgeted for the prior year, 2026-27, and utilize that $4 million starting in year 2027-28 to make or to accelerate the payment to this restart layer. What would have happened in that case? Now, of course, under this scenario, as we have said in the letter, there's really no contribution rate change whatsoever for the employers for the next several years, because the $4 million additional contribution won't kick in until year 2027-28. So the question was asked is, if we were to be able to get the $4 million and use that to pay off the UAAL starting in year 2027-28, how much shorter will we be able to shorten the amortization period of currently at 19 years? So in this case, I'll go back to the amortization schedule one last time. And in this case, instead of the payment making all its way to year 19, as you may remember from seeing the earlier schedule, the entire UAAL for the employer would be paid off in year 16. As a matter of fact, the payment for the last year is actually somewhat smaller than what we would have anticipated otherwise. But of course, in this case, I need to point out again that when you compare these contribution rate stream, you will notice that first year's contribution is unchanged, the 9.7 million from the baseline. However, in year 8, this is the 27-28 fiscal year, this is where we have added $4 million in additional contribution starting in that year. So we add $4 million in year 8, we add out $4 million in year 9, and so on and so forth, until the UAL is fully paid off. Now, in this case, the amount of interest that the employer will be paying is still less than the $115 million that we saw a few minutes ago under the baseline. Is reduced to about $96 million. So as a matter of fact, because this, I said early on, this would allow the employers to pay off the UAL in about 3 years. So this kind of sit almost right in the middle, as far as the interest charge is concerned, between the current 19-year schedule and the other 15-year schedule that we were seeing under scenario 2. So this is kind of splitting the interest somewhere in the middle between the baseline and scenario number 2 that we were looking at. So more contributions, but this hopefully gives, for example, the employer a lot of time, and all we would be wanting them to do is to channel the $4 million that savings that they would, or the $4 billion in reduction in contributions that they would no longer have to pay to the pension obligation bonds, and then we'll be asking them to direct those $4 million towards paying the UAL for the plan, the restart layer, and in the process, we will be able to save them about $20 million in interest. So that's the first scenario. So maybe with that, I'll pause to see if there are any questions or any members of the board you would like us to go into a little bit more detail about any of the results in the 3 scenarios that we have been asked to take a look at.
Well, I'll just start. I think I don't know the exact number, but about 45% of the payroll and 45% of the UAL comes from state and federal sources. So it's about something like 55% that comes from the general fund, local taxes. So, if it was roughly $400,000 that is charged to the county of Mendocino, then that comes out to 55% of that would be about $220,000 general fund a year. I think that was in our scenario 1.
Hi, Andy. So I want to say thank you for this report because as being on the board for the last couple of years and seeing the UAAL and a trajectory that we saw that we were expecting a pay down by this time from when I started, we were hoping to see the curve sort of start going on the downside and haven't seen that yet due to a number of different circumstances, of course, that can happen and such as the salaries and changes made to our assumptions. And so having this information available for options for us in order to get our unfunded paid down, I feel like scenario 1, I know it sounds like we're not making that decision today, that we'll make that when you bring back the actuarial report. But scenario 1 seems very easy to me and saves $8 million easily to the county and pays down that unfunded sooner. Scenario 2 seems a little bit too aggressive, I suppose, and my concern for any of the plan sponsors and what their financial position is at this time. I don't know how the other board feels, but I'm not sure that that is the position that we should take at this point to pass on 2.66 additional costs in to the county or to the sponsors. Scenario 3 also is, attractive because it saves about 19 million. However, that's 6 years or 7 years, 6 years from now. And so to make that decision, I think now would be too far out in the future, but I think it's something that we can keep an eye on. This is just my opinions with what you brought forward. I feel like this is very valuable information. And if we can keep it coming back every year when we have our actuarial to be looking at this restart layer so we can make movement toward paying down the unfunded, I think that would be a responsible thing for us to do, as well as it's interesting to hear Dan say that about the percent of payroll and what comes from state and local government. I don't hear the board speaking about paying down the unfunded and or making attempts to pay more towards it. I don't hear discussions, and maybe I have just missed them, but I think this is something that when we look at contributions and what we can control in our unfunded is very little, really. The benefits are negotiated. Expenses, I don't see as having a big impact that we can really control. So then we're left with investment income and contributions. Investment income, is variable. We do our best there with our asset managers, but really this is a place where we can make a change. And so I hope that we can look to doing something as a board when we get our next report. So just thank you for the information.
Welcome.
Okay, Jim?
Yes, I was going to thank Siegel again for the information and Julie for suggesting to the board that we seek out this information. And I kind of like to echo what Julie was saying. I think if we went down to the 18 years, that saves something, but not at a burdensome cost to the sponsors. And the thing that I think is really arguable about that one is that it just is consistent with our UAAL policy for all new layers. And so we're really not doing anything new with the reset of that global financial crisis layer that was necessary. The other ones begin to get a little more burdensome on the sponsors. And, I think that's something that could be proposed potentially at some future date by the board as something that the sponsors could consider in their financing objectives for the county as a whole. But the other thing that I always come back to on these is that as Andy has mentioned before, is we're really at a point in our in the retirement system where we're at a mature point where it's going to be expensive, and then you're going to see a precipitous fall in UAL as you have more pepper employees, as you have kind of the passing of the more enhanced tiers, and it's kind of a period where you just kind of have to live through and recognize that you have a mature plan, and it's almost more of a as long as our numbers are looking good and we're feeling comfortable as fiduciaries, it's almost more of a discussion, like a joint discussion with the Board of Supervisors as to whether or not accelerating the pay down of that mature plan, the UAL, is an objective for them.
Sherry?
And thank you again, yeah, to Andy, and thanks to Julie for bringing this forward. And I agree with everything that Julie and Jim both said. I think that this is going to be pretty much what Jim's alluding to. I think this will be good information for the Board of Supervisors. One thing that I liked about the third one was the fact that it actually takes a couple of years off of the amortization schedule, which I think is good. But the first one's nice, but it does give us an opportunity to, to look at this. I also think that it's with the Board of Supervisors, they also have pension gap money. I don't know what it is. I think at one point it's about $4 million. I think that this report would give them an opportunity to start thinking about what they do want to do, maybe with that pension gap money, as well as what they will do when they pay off the pension obligation bonds. So thank you, very interesting.
Thanks, Sherry. Julie, do you have your hand raised?
Yeah, I just had a question, not having been around in 2012 and don't know what was the reasoning for the decision of the 30-year amortization. If anybody here can.
Maybe Jim can.
Okay.
I can jump in there, Julie. When we had the global financial crisis, and the portfolios dropped so significantly for everyone, is that folks were scrambling for something that would really not cause bankruptcy for the plan sponsors. And it was literally nationwide, and certainly statewide. And most of the systems went to a reset. As a matter of fact, I think both CalPERS and CalSTRS, Andy can correct me if I'm wrong, they went to a 30-year amortization period where each new year they did a new 30 years. And because there was a great uncertainty as to what the recovery was going to look like coming out of the global financial crisis, so they provided both the plan's survivability and the employer's survivability and avoidance of bankruptcy as a significant factor in deciding what the amortization schedule would be. Then as the markets started to recover and the plan assets started to recover, that's when a kind of system statewide, including MSERA, looked at how do we reasonably get back into amortization that is more consistent with what we think is good stewardship of the plan.
Thank you.
Just follow up on what Sherry said. I think we could be looking at one recommendation from this board to the Board of Supervisors, because honestly, I think they're going to need to hear from us. But for example, if we were to look at a hybrid of 1 and 3, if we took the pension reserve, which I think is around $4 million, that could be used to make those supplemental payments in the plan 1 for the first 7 years, and then in year 8, when the pension obligation bonds will be paid off, we could then have the accelerated payments that are shown in option 3. So I'm just wondering if we could get a look at the cost to those. And again, if you look at if the cost to the county was $400,000 in year 1 of option one, the general fund obligation is only going to be around $220,000. So that $4 million might be able to carry us through for the first 7 years.
Yeah, and through the chair, if I may make an observation.
Go ahead.
Yeah, because you have just heard from Greg and Callan, it sounds like the year was on a very positive projection, at least for the first 9 months of the year. So an observation I think can be made that if we end the year on a high note and if rate of return were to come in at double digit, even though we will have to go through the assets moving method, right? We take the good news and the bad news alike, and then we spread it over a period of 5 years. Now it is possible. I don't want to build up a lot of expectation, but at least it is possible that if we end the year strong on a very strong note, and if the contribution, if we have an actuarial gain, then everything else being equal, that would cause the employer's contribution rate to go down, right? Because after all, we take the gain and amortize that over 15 years. So I think it remains to be seen. It would be interesting to find out if that were to happen, whether or not the instead of letting the contribution rate be reduced for the employer, what would happen if we just ask the employer to pay the same amount, whether or not that would be close to or less than or over the $400,000 that we would otherwise ask them to pay. So in other words, instead of letting the contribution rate be dropped, because if there were to be superior investment performance, we can certainly reduce the amortization period by 1 year or whatever number of years, so as to basically take charge of the contribution rate reduction that would otherwise follow. And so that way, when we present our next valuation to the Board of Supervisors, they won't see any increase, but we will be able to tell them that we are utilizing those gains and basically buy down the current 19-year amortization period by some amount to 18 years or whatever the math works out to be. So that's just another possibility.
Okay, Quincy?
Overall, I just want to mirror some of the comments from the other board members that I very much appreciate this discussion as a whole and the presentation from Siegel regarding this matter. And I think the other board members probably appreciate and realize that with the historical benefit review project that we have going on, that some of those other items are going to be absorbed by the UAL. So this is going to be a moving target here for a period of time, but us taking an active role in an attempt to lower that rate or that interest that we may be paying over time, I think is important and probably a legitimate recommendation to the Board of Supervisors. And I wasn't looking at these options as exclusive from each other. I was definitely more looking at some of what I believe I interpreted Dan's comments to be of maybe making a recommendation for one, and then also a later recommendation, multiple years down the road. So those were my comments. And just as a side note to Andy, it looks like on your guys' header for your reports, there may be a spell check error with Paul's last name. So.
Okay, we'll take a look at that. Thank you, Casey.
Yep.
This is Richard. Can you hear me?
Yes.
I would echo Dan's suggestion, I think, during the conversation of scenario 1 and 3 as a combo. The 89 with the $84 million that was talked about being saved on the one is pretty incredible. And if we landed somewhere near that or in between that number and the lower number, I think that's a pretty important thing to do. But again, a combination sounds very interesting.
Okay. Do we have any other board comments at this time? I'm just looking. This is great information, and we don't want to put too much more work on Siegel. But on the other hand, how do we kind of make this so that we could, if we wanted to, kind of craft some options that we're presenting to the Board of Supervisors? What are our options here between you and Sarah's staff?
I think we can give them direction to include these scenarios in the June 30, 2021 valuation as options for the board to select from. And again, it would be good to coordinate this information with the county so they're aware of the potential impact.
Okay. Jim?
Excuse me. Maybe if in the direction we could add as one of the alternatives to what Andy had described as if we see a reduction in the employer contribution rate, is a potential suggestion to maintain the rate as a UAAL pay down method as well.
Okay. I'm just also curious, would the board be interested in having, obviously there'd be some staff with MSARA, with county budget staff, maybe even a couple board members could be party to that. I'd be willing to be part of that if we had a couple board members. Sherry?
I'd be happy to as well.
Okay.
Sherry.
Sherry, you're muted.
Sorry. So I wasn't, what I was thinking was at some point, do you think we would ever have a dual board meeting like we have in the past? I know that that's been talked about, and it seems like this would be a really, really good topic. If we had a meeting, this would be something that could be discussed with the full board of retirement, full board of supervisors at a meeting, like, maybe even towards the end of the year when things tend to open back up. I know that that's been discussed, so I don't know if that's still, if anybody still has an appetite to have that meeting, but it does feel like this is definitely something that runs with both boards.
I agree, Sherry, that's a good suggestion. There are a number of other boards that are trying to meet with board of supervisors this year. Last year, things were kind of on hold because of COVID, but it maybe we can by the end of the year. Yeah, I still think maybe some sort of pre-meeting would help that, so we could have some tangible proposals. So if it's okay with the board, Julie and I could meet with Doris and the county budget team. Sherry, you're probably part of that anyway.
Yeah, yeah. Well, I'm not part of the budget team, but I have the historical knowledge. So
yeah. So maybe we could do that as soon as possible to kind of flesh out some of these ideas.
If you want, excuse me, I had something to say. I don't want to interrupt you.
Okay, go ahead, Catherine.
Also, I do the budgets for the district attorney's office, so it might be helpful to have somewhat of a diversity of people on a group that could have, maybe different perspectives on this.
Sure, I think we can have an ad hoc of up to 4 board members, I think.
Well, I'd be interested in being part of that too. Thank you.
Okay. Okay. All right. Is there anything else we need to do on this agenda item?
Just to clarify, Dan, we're appointing an ad hoc, and can you let me know the 4 members?
Well,
members?
I said Julie, Sherry, and Catherine, and myself.
Thank you.
Okay. And was there anything else we needed to do on this item?
Public comment.
Yep, good point. Do we have any public comment on this agenda item?
No public comment at this time.
Okay, all right, thanks.
Thank you, Andy.
Thank you.
Thank you.
Okay, I guess that takes us to the item number 6, which is discussion possible action regarding appointment to the audit committee. Would someone like to be on the audit committee?
Judy?
I'm already on it, so who's already on it?
So the audit committee consists of Julie Forrester, Catherine Cavanis, and Jim Anderson.
Okay, do we need a 4th member or?
Yes.
Okay, we need a 4th member.
Kathy would be great.
I don't.
If you, unless you don't want to be, is that too much?
Well, I thought Quincy would like to be,
Oh,
and I'm fine
okay.
with him
Thank you. I
doing
forgot
that
about
as
that.
well. But thank you, Sherry. I'd be glad to do it when necessary. But Quincy,
Does Quincy
if
wanna
you
be
want to
on it?
be on it. I
Mr.
thought he
Chair, if I
did.
can address that. I was under the understanding that I was selected for it in December 11th of 2019, but I've never been invited to attend any meetings. And with my current workload, I have no problem stepping aside for Catherine. I have quite a few work commitments that take my attention away. I understand this only meets once a year. So if there weren't any other people interested, I have no problem being on the audit committee. But if there are others that are, I definitely step aside for that. But I may have been under the misunderstanding I was already on it from December of 19.
Okay.
Well, I'd be happy to if nobody else wants to. I'm interested in it.
Okay. Do we need a motion or can the chair just appoint?
I think the chair can appoint.
Okay, so I'd like to reappoint the existing 3 members, Catherine, Julie, and who was the 3rd?
Jim.
Jim, and also add Catherine Smith.
Thank you.
It's hard to see all you on the Zoom meeting and also look at the agenda at the same time on a
Yes.
regular laptop computer. Okay. All right. Well, then that takes us to item 7, unless people would like to take a quick break. Okay, let's go on to 7 then, which is discussion possible action regarding resolution 2021-1, defining compensation earnable.
Thank you, Chair Jurdy. There's a new resolution for adoption. It is adding a new pay code in response to California Senate Bill 95 for COVID-related paid leave time. That is code 388. As far as permanent employees, our recommendation is that code as paid leave is pensionable, consistent with all past other paid leave codes. Additionally, there is a correction to this list to add in a code that was omitted from February of last year, which was also a COVID relief pay code 392 under the federal COVID Relief Act. So our 2 resolutions, the resolution on item 7 is for the addition of the pensionable pay codes to compensation earnable for non-PEPRA members, and that would need action by the board.
Okay. Any questions? Do we have any public comment on this item? All right. Would someone like to make a motion?
I'll move to adopt resolution 2021-1 as presented.
I'll second.
Okay. Judy, can we have roll call?
Ms. Chatmeyer,
Yes.
Ms. Forrester,
Yes.
Ms. Cavanis,
Yes.
Mr. Jurdy,
Yes.
Ms. Smith,
Yes.
Mr. Cromer,
Aye.
Mr. Shoemaker,
Aye.
approved.
Okay, right. Then item number 8, which is similar, discussion possible action regarding resolution 2102, defining pension pensionable compensation for Pepper members.
Thank you, Chair Jurdy and members of the board. This is the same resolution, but just including those pay types for the coronavirus relief pays in the pensionable compensation for Pepper members.
Okay, any questions? Do we have any public comments on this item?
No public comments.
Okay, would someone like to make a motion?
I'll move to approve Resolution 2021-02.
Second.
Okay, can we have roll call?
Yes, Ms. Schotmeyer,
Yes.
Ms. Forrester,
Yes.
Ms. Cavanis,
Yes.
Mr. Jurdy,
Yes.
Ms. Smith,
Yes.
Mr. Cromer,
Aye.
Mr. Shoemaker, Mr. Shoemaker.
Aye.
Thank you. Approved.
Okay, all right. Well, that takes us to the Retirement Association work plan.
Thank you, Chair Jurdy and members of the board. The board's work plan has been included in your packets. Significant changes to this plan will show that there's a few more yellow unimpressed faces. This is primarily due to additional workload from the historical review project that has slowed down progress in other areas of the board work plan. One item I would like to mention is that several months back, we had moved to publishing our newsletter quarterly to provide staff with a little additional time to focus on the project work. After discussion with staff, it really looks like we are not ready to move back to monthly production. When I originally had taken this to the board, we had anticipated being able to move back to monthly newsletter production in April, and we would like to continue to publish only quarterly until we make additional progress on the correction project. I'm happy to answer any specific questions the board has regarding anything on the board's work plan.
Okay, any questions? Just that I appreciate the fact that you're being really direct about the need for focusing on the historic review benefit review project and reflecting that in the work plan. Oh, Julie.
Just that we, excuse me, may want to add in to this that we now have the ad hoc to meet with the board regarding the unfunded liability, because that's part of the working towards the 2040 fully funded status and the review of the actuarial report. I thought I saw that somewhere else in here as well. So we might, those two items that we took today, maybe we want to add to the board work plan as continuous.
Thank you. I'll add those as actions the board's taking towards completion of the unfunded liability item.
Okay, great. Do we have any public comments in this item?
No public comment.
Okay, all right, thanks. Okay, great. Well, then that takes us over to the State Association of County Retirement Systems business meeting.
Thank you, Chair Jurdy and members of the board. The SACR's business meeting board packet was provided to you, I believe, both separately when we received it, then also as part of this board agenda packet. This item is looking for the board's direction to the SACR's voting delegate on the items in the SACR's business plan that will be voted on at the spring conference. There is a couple of routine items, the Secretary Treasurer's and Audit Committee reports, but the two items that are needing specific direction of this board to the voting delegate would be whether or not they wish to support and Sackers formally sponsoring Senate Bill 634. It is described primarily as a cleanup bill to clarify things like that the Board of Retirement may contract with a private physician to provide medical advice and deleting some obsolete references and things of that nature. They're considered non-controversial changes to the serial. The other item would be direction to the voting delegate on the proposed slate of candidates, whether to vote both as the slate as a whole and individually on any particular position.
Okay. Would someone like to make a motion on this? Catherine, you go to all the meetings. What's your recommendation?
I would recommend to support Senate Bill 634. It's just a cleanup, basically, as Doris said, it's basically a cleanup bill. And it's not controversial. So I make a motion to support SB 634.
Second.
Okay, got a motion and a second. Do we have any public comment on this item?
Public.
Okay, none. Okay, all right. Can you, I'm not seeing any comments on the motion, so can you call the roll?
Yes. Ms. Schottmeyer?
Yes.
Ms. Forrester?
Yes.
Ms. Kavanaugh? Ms. Kavanaugh?
I said, oh, I said
yes.
Sorry.
Mr. Jurdy?
Yes.
Ms. Smith? Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Approved.
Okay, that takes us to the administrative report.
I'm sorry,
Did you
need a motion regarding the slate of candidates?
Oh, go ahead. So would someone like to make a motion?
I don't think I can because I'm on the slate.
I'd move approval of the slate.
Second.
Okay, all right. Can you call the roll?
Yes. Ms. Schottmeyer?
Yes.
Ms. Forrester?
Yes.
Ms. Kavanaugh?
Yes.
Mr. Jurdy?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Approved.
Okay, does that take us to the administrative report?
Yes, thank you, Chair Jurdy. Members of the board, the administrative and operational update is included. As a reminder, the Form 700 was due April 1st. If you have not yet submitted that, please get that to Judy as soon as possible. There was also a Sackers legislative update provided in your packet. I'll also touch on the fact that the county is poised to move into the orange tier, which will lift some of the COVID relating restrictions. And we will be looking at potentially bringing more staff back into the office more days a week, although we will continue to utilize telework even in the future as COVID restrictions are lifted. The last item under the operational updates was that, believe it or not, in like 5 weeks, I will have been here an entire year. I do look forward to meeting some of you in person one day. As part of that, it will be time for an evaluation, and we'll be distributing the evaluation forms next month in order to complete the evaluation process at the June board meeting. And as I had previously stated, progress on the historical benefit project has been slower than initially projected. This is due to a number of reasons, primary of which is just the volume of work given FASERA's MSARA's small staffing level. We had brought on an extra help position in October. That person left March 4th, and we have just received permission to fill that extra help position again and hope to bring that person on soon. That does slow things down a little bit as we get that member trained to provide support staff like scanning, answering phones, and routine correspondence. I have noticed in a preliminary review that there are some work tasks that we do not have more than one person trained on, and I'm going to continue to work on identifying those and establishing a cross-training plan to ensure that we do not have any single point of failures in any particular area of the plan, that we always have somebody else to serve as a backup, even for periodic and things that may only happen once a year. So the last item is that I think in the long term, it would benefit the system if we did look at adding another permanent full-time position to the retirement specialist to provide some depth of bench and to improve the workflow. Even once the project ends, I believe there is actually sufficient work that would keep a full-time staff member busy, especially once we remove the extra help position. I just wanted to throw that out there as something for the board to consider as we move forward with budget things this year or next. I'm sorry, you had a question, Ms. Forrester?
Just wondering, the position that you'd like to add, what would be the class specification or job title that you were seeking?
I would be adding a retirement specialist. Let me actually give you also an update on a project that had been ongoing, which was the classification study with human resources. They have been actively working on it. I have updated job specs to review and get back to them. We expect that this will go to the Civil Service Commission meeting next month. They happen to meet on the same days as the Board of Retirement, but they're trying to schedule it so that I can go to that meeting after the board meeting here to look at making some changes in the classifications, going from a retirement specialist 1 and 2 to a retirement specialist 1, 2, and 3, removing the senior specialist, but adding a retirement analyst potentially, are both the recommendations included in the preliminary information I've received from Human Resources. So I'll bring more information back to you on that, likely at the May or June meeting when I have that report from Human Resources. But I did want to let you know that HR has been actively working on this. We do expect to see it come to fruition and completion here within the next couple of months, and that they are actually suggesting changes to some of the classification structures we have.
Okay, thank you. Any other questions? Do we have any public questions on this item?
No public comment.
Okay, all right. We have the last thing on the agenda is, unless people had comments on the legislative report, would be general board member discussion. Any general items? Quincy?
I just wanted to notify the other members of the board that I was asked by the Deputy Sheriff's Association president to attend their meeting tonight in Ukiah and give a short presentation regarding the historical benefit review project. So my intention is to attend that meeting and distribute some of the frequently asked questions, documents, and other things from our website that were prepared and posted there, and then recommend that anyone with questions, because of course these members are still current members and therefore they're still members of the DSA, that we haven't reached any current employees yet, and it's still retirees at this point. And if they have questions, to direct those towards the staff at the Retirement Association.
Okay, thanks. Jim?
Yeah, just real quick. We had a meeting of the AMCRE board last week, and similarly, there was an update on the historical benefits review project. I explained what was appropriate or answered questions that were appropriate. I followed up on a couple of items and copied Sarah on my follow-ups just to make sure that we were congruent in what we were communicating, and like Quincy referred the members back to MSARA.
Okay, thanks. All right, well, I think that then would take us to item 13, our closed session item, or I'm sorry, 12, our A, B, and C closed session conference with legal counsel.
So
Sherry?
for the application for disability retirement by George Hodson. The board voted to grant the application for service-connected disability retirement. Trustee Jurdy voted no, and Trustee Cavanis abstained. On the Chavez application for disability retirement, the board voted unanimously to adopt the hearing officer's decision, which was to deny the application for service-connected disability retirement. And on the potential litigation matter, the board gave direction to staff and council.
Okay, at 11:53, we will be adjourned.
Thanks, everybody.
Thank you. Bye-bye.